All right, my friends, so I'm going to show you a website and how they talk about the science behind their portfolio selection and architecture. Portfolio architecture, for the love of me. All right, so this is directly off the website. I'm not going to name the firm. I just want to show it to you because you'll see a lot of dimensional fund advisors and fiduciaries who hold themselves out as holier than thou use this almost identical verbiage here. Portfolio architecture is part art and part science. There's no science, none whatsoever. Investing is not a science any more than economics is a science. There is no science behind this stuff. It's just hypothesis from a soft science perspective. I guess you could still say a science, but I'd say it's like, is political science a science? No, it's just this people who want desperately, they have physics envy to be seen as they're scientific to along the lines of chemists and physicists. They're not. Human behavior is, in terms of the emotional, is soft science. Psychology is a soft science. I don't know. I imagine there's some psychologists who say they want to be a hard science too. It's not. It's soft science, man. I mean, it's just human behavior, emotions are not a hard science. Gravity is a hard science. Your investment decisions are not a hard science. They're just not. All right, so let's go into this. But I guess you could say it's scientific in that they've done research on it. They have a hypothesis. But again, you can't. It's not the same. And I hate when we use this as if we're trying to be. Economics is notorious for trying to the physics envy. Look, we've done research that will say human beings. It's just no. All right. So portfolio architecture is part art and part science. Thanks to Nobel laureate academic research, we know where returns come from. Oh, for the love of me. No, you don't. You don't know where returns come from. Studies suggest 94% of portfolio performance can be explained by asset allocation alone. No, they don't. They don't. The Bender study does not explain that. It explains variance of returns. Diversification is your best friend and the only free lunch available today. Now, I agree with that. I agree diversification is what you should have because you just don't know. But I'll tell you right now, the diversification is not a free lunch. If you bought Apple in 1998 and put all your money into Apple, you were not diversified and you are a wealthy person today. All right. So is that luck? Yes. Diversification is luck too. You just don't know. You don't know. The reason why we say diversification is the way to go is simply because luck will minimize the likelihood of you going bankrupt if things happen according to historical norms. That's just what we're saying. It still can happen, though. I mean, we have looked at throughout history of all these different countries. There's no more Roman Empire. The UK, for instance, is not what it was 100 years ago. I mean, just so many. I mean, South Korea, 50, 60 years ago, is much higher than it was today. When I was my parents would say, "Eat what's on your plate," because they're starving in China. Now they're still starving in China, but still, China is now the second largest economy in the world. I mean, all these things change. So diversification, while it is a good thing to do because you're saying value today, growth tomorrow. I don't know which is going to go, so I'm going to do a little bit in both. What we always say is diversification means you're always going to have to say you're sorry. Gold in the 2000s, the number one performing fund was the USA Gold and Precious Metals Fund. If you had that, you were living life, loving life. If you had it in the next 10 years, you're hating life. So if you have a little bit of gold and a little bit of stocks, a little bit of bonds, the whole thing, you're just going to be better off. Historically. But I don't know if it will be true in the future. But here's what really drives me crazy. Minimizing expenses, transaction costs, trade-related taxes results in higher investor returns. I 100% agree with that. And I can share with you why I just laugh when I see this on this firm's website. Minimizing expenses results in higher investor returns. I completely agree. Completely agree. With over a century of data, we have enough history to know what works and what doesn't. See, I hate that stuff. I cannot tell you how much I despise these two things. Noble academic research, we know where returns come from with a number 5 bullet point. We know what works and what doesn't. No, you don't. You don't know what works. This isn't gravity. All right, so let me pause for a second. I will show you this other thing about the minimizing expenses. Hold on just a sec. You'll get a kick out of this. Now, because these guys don't show their fees on their website, you have to dig through the SEC ADV form, which I've done for you. And look, I'm not, you see, I whited out the name of their business, so I whited, so you don't know who this is. Theoretically, I guess you could look it up. But at the end of the day, I've whited it out, so we're not, we're allowing the guilty to maintain their anonymity. Anonymity. When I was in AA, we used to have to say anonymity while you're reading from the Bill W.'s book. And man, I never could do that. I always say anonymity. Hey, I'll be able to say it now. But it's always nerve-wracking when you have all these other people listen to you read that sentence from Bill W. Look, man, if you're having a struggle, and go to AA. I'm telling you, it's a wonderful place to go to help with your struggles, regardless of what it is. It changes your mindset for sure. So I'm happy to admit my attendance at AA. All right. Fees and compensation. So remember, we just talked about how fees can minimize your investment returns. We just talked about that. We talked about it because that's what they stated very explicitly on their website, that fees hurt your returns. Advisory fees. We earn fees and compensation by providing advice regarding portfolio management strategies and assisting clients in planning for financial goals. Our fees for services are as follows. Fees for portfolio management. First, 0 to 500,000, 1.5%. Now remember, DFA also has their own fees, and maybe we'll show you what those fees are for the DFA funds that these guys are certainly using, because I found them through the DFA website. Next, 500,000 to $1 million. So basically, between 0 and 500,000 is 1.5. Between 500,000 to 1.5 million is 1%. So the first $1.5 million, you're paying no less than 1%, if that makes sense. All right, and then you can see how the fees go down. So let's take a look. Fee example. So $1.75 million portfolio. 500,000 is 1.5, 1 million is 1%, 250 is 0.75%. Your quarterly fee is $4,800. Your annual fee is $19,000 bucks. That's just here, what they're showing you. So how come investment, when they talk about fees, reduce returns, why is that not part of that? So I mean, literally, if I'm making, let's just tell you, I don't have my calculator, I use my trusty old phone here. So if I have a investment return, and I'm just using investment returns now because it'll go on the negative side too, of 8%. Let's say I got how much do I got in there? I got 1.75 million, and we're gonna say I made 8% times 0.08. So I made $140,000 of investment returns of 8%. So I made 8% on 1.75 million, but I lost 19,000 of that to investment fees. So of my returns, I lost 7.22% of those returns to investment fees. All right, so that's how it works. Now let's say 1.75 million, and I made 4%. All right, so in that case, I made $70,000. What's my investment fee? It's still 19,000. It's gonna be more because I made money, but still, we're just using this for an example. I paid 19,375. In that case, I paid, no, I'm doing it wrong. 19,000, oops, 19,375 divided by, what did I say, 70,000 bucks? I did it wrong. So I paid 27.6% of my returns to these guys right here, and that's before investment fees from DFA. The other one actually, excuse me, 19,385 19,385 divided by 140,000. I pay 13.8% of my returns to these guys in fees. Now, lastly, let's just say we went down. So we went down 5%. All right, so now we're 1.75 million, and we minus 0.05. So we're 1.75 million times 0.05. So now we're down $87,500. Well, we're going to be down another roughly $19,000 as well. So now I'm down $106,000 off a $1.75 million portfolio. So 106,000 on 1.75 million. I'm down 6.1% when the total portfolio was actually only down 5% because of the fees. See how the fees just eat alive your returns on the up, and they enhance the returns on the down. enhance, I mean make it hurt more hurtful on the down. All right, so let's see what DFA charges itself. So I'm going to pause again. We're going to go to the DFA website. All right, so here's the DFA website. And again, I'm not trying to bash dimensional fund advisors or people who use them. I hate the idea we're using science as our basis for you to hire them, as opposed to the guy Ed Jones who's going to charge you 2.5% front-end commission. I think is absolutely ludicrous, and I hate the idea these people are throwing around the term fiduciary so loosely, as if they're as pure as a winter of snow, while the other guys are not. Because I find that all the time. It actually drives me crazy. All right, so let's see. It's about let's take a look. Okay, do you have investment strategy? Okay, so how do Dimensions results compare the industry? Selected universe that outperformed industry benchmark, 14%. Dimensional, 73% of the funds outperformed the benchmark from 2003 to 2017. Not sure why they didn't do 2000. It's odd to me, but whatever. Okay, so that's 15 years. I guess that's what they're doing. But that doesn't include the fees that we just talked about. So that's fine. So you're saying Dimensional's outperformed. Yeah, it has outperformed, but it hasn't outperformed with fees. All right, so let's keep going down. You can't see this whole thing. I don't know if I can make it bigger. All right, so let's go down here. I want to show the funds. All right, so we just talked about this industry. Over 14% of equity funds have beat their Morningstar category over the 15-year, where 73% has. But again, we're not talking about the fees that you buy. You have to pay the investment advisors. And the investment advisors, you have to pay the fees if you want to get dimensional fund advisors in your portfolio. Financial science, that's what I love, financial science. And here's all the smart guys. And look, I got no problem. I don't want to sound like, I'm anti-French fam. I'm not. Or this guy Booth, who I think right there, David Booth. I'm not anti these guys. I like dimensional fund advisors. I just don't like the fees you got to pay for them. I don't think it's worth it. All right, so let's empirical economic theory backed by decades of empirical research. Yep. New research. Okay. Robust science. Applying insights from financial science. Let's keep looking here. Understanding what drives returns as a starting point. From here we focus on fine-tuning our method of capturing them. Look, that's all great. I got no problem with that. But again, the problem is you're not taking the fee. So why is dimensional fund advisors selling that they outperform, but they're not selling the elephant in the room, which is the 1 to 1.5% fee that most dimensional fund advisors charge? I mean, come on, man. Yes, the funds are great. I got no qualm with that. If you can get it without paying a 1 and a 1.5% investment management fee, you should buy dimensional fund advisors. No problem with that. But come on, this is only half the argument. I find it to be incredibly misleading, and they don't have to do that. Drives me crazy. What they should do, the science is, let's see, the science, applying insights from financial science. Well, put the science with the investment fees like Bogle does. You have a market that returns 8. Some people get 9, some people get 7. Thus, your market is 8. But you factor in, there's a 1% fee for all the people in the market. That 9% now has 8%. That 8% has 7, or the 7% has 6. But the market still give you 8 because the market has no fees affiliated with it. But the investment advisors do. That's where you got to read Bogle's book. All right, so let's go to their funds and just see what their fees are on their funds. All fun. Oh, sustainability investing. Love that. I guarantee it's not nuclear, but let's just look at the funds here. I have no idea. Yeah, expense ratios. I hope you all can see that. Fantastic. So here, expense ratio net 0.54. That's on a small company. On a bond fund, California bond 0.23, 0.54 again, 0.19, 0.2. So based on average, about 25 basis points to 50 basis points. So again, you're paying the guy we just showed. You're paying 1.5% on the first $500,000 plus the DFA fees. We'll just say on average is 35 basis points. That's going to be 1.85% all in, my friends. On the next million, you're paying 1%. So 1% plus the 0.35 basis point for DFA fees, you're paying 1.3. Or you just go to the Vanguard Total Stock Market and be done with it, pay 4 basis points. All right. That's all I got for this. I hope this is illuminating to some degree. It's frustrating. No other way around. It's frustrating. It's misleading because we know DFA guys, they know the science is that if you take the fees, reduce returns. They know that. I mean, no one does not know that. They know that, but yet for somehow they're trying to make it seem like the fees are not part of this whole thing. And they are, because that $19,000 we just showed you is coming from your account. All right, we'll see you next time.